Hi guys. Today we will analyze Foot Locker stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The long-term trend is still negative, but the short-term trend is neutral. It is advised to wait a little bit longer to see how this turns out. Support level is around $42. The next support level is around $40. Resistance levels are around $45 and $47.50. The next resistance levels are around $50 and $53. In the last month the stock has been trading between $41 and $47.50 range, which is quite wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 2 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 3% per year, for last 5 years. We see that the average profit margin of the stock has been around 6% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 136% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Foot Locker Company: bad, average, and good. First scenario. Foot Locker will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 1%. Future profit margin would be low, 4%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $42. The second scenario. Foot Locker will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 5%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $59. The third scenario. Foot Locker will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 5%. Future profit margin would be high, 6%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $81. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 8.76. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Foot Locker, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 6. Again, I will use 3 different scenarios for Foot Locker Company: bad, average, and good. First scenario. Foot Locker will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 1%. Future P/E would be low, 10. In this case, the fair value of the stock today would be $35. Second scenario. Foot Locker will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future P/E would be average, 12. In this case, the fair value of the stock today would be $49. Third scenario. Foot Locker will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 5%. Future PE would be high, 14. In this case, the fair value of the stock today would be $69. As you can see, today the stock is fairly valued, $44, even if we expect the company's medium performance in future. Both the profitability and the financial health of Foot Locker are neutral. The stock is valued quite cheap, while showing a decent growth score. This is a good combination. I own the stock and I buy more when it's around $40. And I like its dividend, 2.74%. Company strengths. Foot Locker is an athletic shoe, apparel, equipment and accessories retailer with 3,000 stores in 27 countries and 136 franchise locations in the Middle East. The company recently launched private label brands. The stock has an attractive valuation and management has signaled confidence in the company's outlook by raising the dividend and buying back stock. Based on estimates for the next 5 years, the company will show a quite strong growth in earnings per share. The EPS will grow by 18% on average per year. Foot Locker's return on assets of 11% is amongst the best of the industry. Return on equity of 27% is in line with the rest of the industry. The company has a profit margin of 10%. This is amongst the best returns in the industry. Risks. Management expects supply chain constraints, including factory shutdowns and port congestion, to be a headwind in 2022. The company's performance is dependent on overall economic conditions, and soft consumer spending and changing fashion trends could lead to lower than expected revenue and earnings. In addition, it depends on strong foot traffic at shopping malls. The company also faces intense competition and its efforts to improve brand awareness and offer better merchandise could fail to achieve the expected results. In addition, Foot Locker is highly dependent on Nike brand. The company is expected to show only a small growth in revenue. In the coming 5 years, the revenue will grow by 5% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.